Hey everyone, welcome back to Alpha Insights. I'm Archer, and with me is Morgan.
Morning. Good to be here. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
The story we want to walk through today is a pretty classic option setup on Poet. A big concentration of calls just above the stock and an expiration that comes up this week. Price has already run, but the options chain is where the real drama could show up.
Right. The tape this morning looked like ordinary momentum on a stock that's rebounded hard from its April lows. Remember, it's up a couple 165% off that low. But the options board has a single strike that stands out.
Exactly. There's a $15 strike this week with a wall of open interest. 20,308 contracts sitting there. That's roughly 5% above where the stock was trading. And it changes the risk profile for market makers.
To be clear, that number itself isn't a squeeze. It's a loaded structure that can create a squeeze if price, volume, and the calendar all line up. So let's break down how that works.
Good idea. The basic mechanic is dealer hedging and gamma. When a retail trader buys an out-of-the-money call, a market maker usually sells it. To remain neutral, that dealer shorts or buys the underlying stock in proportion to the option's delta.
And as the stock approaches the strike, the call's delta increases. Dealers then need to buy more stock to stay hedged. The closer to expiration, the faster that delta moves. That's the gamma effect. The buying can feed on itself.
So picture a wall of calls at one strike, just above spot, with only days to go. If price pokes through that strike on rising call volume, dealers suddenly need a lot more shares to hedge. That buying can drive price higher, which forces more buying. Classic feedback loop.
And on Poet's chain this week, you have not just the $15 concentration, but a secondary shelf at $18 and $20. Between those levels sits more than 11,000 additional contracts, which could be the fuel for a second leg if the first move sticks.
Let's talk triggers, the practical levels to watch in the next 3 trading days. First, the primary trigger is a clean break through $15 on rising call volume. Calls at that strike currently have deltas roughly in the 0.25 to 0.35 range. If they push through, deltas can move toward 0.5 to 0.7, forcing dealers to buy a lot of stock.
Analysts note that could translate into dealer hedging demand in the ballpark of 700,000 to 1 million shares, just for that strike, if the move is clean and volume is strong. That's meaningful relative to normal daily volume in a smaller name.
And confirmation would be holding above about $15.50 into the close the next day. If the stock closes and holds there, the wall flips from resistance to a floor, and hedging accelerates rather than fades.
Then the next acceleration zone is around $18. Push through 17 into 18, and you bring in that secondary shelf, which can decouple the move from fundamentals for a time. But, and this is important, the whole thing needs fresh call buying. The existing 20,000 contracts are positioning, not a guaranteed engine.
Yeah, that's a good point. Volume matters. If the $15 strike trades 3,000 to 5,000 contracts in a single day, with the stock holding above about $14.50, the setup gets live. If volume is quiet and the stock fades, most of these structures simply expire worthless.
Now let's get into a counterintuitive piece that trips up a lot of retail commentary, the rollover. Say the stock does push through 15 and those calls go in the money. Traders can either exercise, sell, or roll those positions into longer-dated calls.
Rolling is common. You sell the short-dated in-the-money call and buy a longer-dated, higher-strike call. But that sequence has 2 effects. First, the dealer who bought back the shorted call will sell stock because their hedge is no longer needed. That selling can push price down even after a big run.
Second, the dealer who sells the new, longer-dated call is short again and has to hedge that new exposure. But the new call often has a much lower delta than the short-dated in-the-money one. Net, the act of rolling can create a delta unwind. Dealers sell more stock than they buy, even while it plants fresh open interest further out in time.
So a successful initial squeeze can actually seed the next one. The gamma doesn't vanish. It migrates to the next expirations and higher strikes. That's why the strikes in the next week's chain matter even now.
Exactly. But there are ways this setup dies. One killer is a stall. If Poet just trades in a range and fails to break 15 by midweek, Theta burns the calls and dealer hedges unwind slowly. Another is if long-term holders who wrote covered calls get assigned and don't replace stock. That natural supply can absorb dealer buying.
And then there's macro risk. If the market turns risk off broad enough, speculative names typically fall with the tape, regardless of strike level positioning.
There's also event risk. The company has first quarter results expected around this window. If earnings land before or during expiration and surprise to the downside, that can collapse the structure in a single session, especially given ongoing corporate headlines.
So where does that leave us? Today's move is spot-driven momentum. No clear evidence yet of a dealer hedging cascade. The wall at the $15 strike is a loaded structure. It could produce a squeeze if the stock breaks 15 on rising call volume before options stop trading this week, and if the market cooperates and earnings don't blow it up.
But most of the time, these walls don't fire. Analysts remind us that the mechanics only matter when price, volume, and time converge. If they do, dealer math creates observable buying that feeds on itself, and the secondary shelves provide fuel for a second leg. If they don't, this will be another well-constructed setup that expires without incident.
All right, quick wrap up from me. Watch the $15 level, watch call volume at and above that strike, and watch how the stock closes into the expiration week.
From me, remember the rollover dynamic? A squeeze can create selling as positions are closed and new ones opened, and earnings or a market sell-off can flip the script fast. Analysts note this is informational, not a trade recommendation.
Got questions? We'd love to hear from you. Head over to stockalpha.ai where you can ask us anything and we'll answer live. And while you're there, check out more market content.
Yep, drop your questions and we'll dig into the tape tomorrow. Thanks for listening.